Hi, my name is Nathan. I'm a principal at Shorooq Partners. Shorooq Partners, we're the leading technology investment firm in the Middle East and North African region. We're headquartered in Abu Dhabi and are also served by 5 other offices in Dubai, Riyadh, Cairo, Islamabad, and Seoul, Korea. Our objective is to provide superior risk-adjusted returns to our LPs, and we're humbled and proud to count 8 sovereign wealth funds that are supporting us in that journey. We make our investments through both equity and credit. As the principal, I lead the firm's venture debt practice. We are the first dedicated venture debt fund in the MENA region, and we're proud to be pioneering this space and are excited to work with top-tier talents and founders to provide them with non-dilutive financing to continue growing their startups. It's a great question. Venture debt, in simple terms, is a way of investing into startups through credit, in essence, giving them a loan. Why is venture debt needed? We can look at it from the founder's perspective and the investor's perspective. So from the founder's side, equity is great when you're first starting out and you're having new strategic initiatives, you're expanding into new markets. But once you reach a certain stage in your company's journey, equity becomes a very expensive form of capital because you're not looking at strategic capital, you just need funds for working capital to continue cycling and scaling up the business. This is where debt comes in. Because debt is a non-dilutive form of capital, meaning you don't need to put up your shareholding or cap table. It's a great way to scale and raise en masse. It's a great way to add some discipline to your cash flow. And finally, through that, you can grow the business and scale to hit that next level of benchmarks and KPIs. Such that when your next equity round comes, you're able to command a much higher valuation. Now, from the investor's perspective, it's a great way to get some exposure into startups with a downside protection. A lot of investors, and especially international investors, are very interested in the MENA region. But many of them also think because it's an emerging market, taking on that additional VC equity risk is a bit too risky for their appetite. Debt provides that risk-adjusted exposure where you're able to get exposure into that high-growth, accelerated emerging market venture space, but also with security and senior preference status, such that there's a downside protection. So we have found venture debt actually to be a very attractive proposition to many international investors. And for many of them, it is their first investment into the Middle East. I think there are 2 characteristics that makes venture debt really stand out. The first is the fast distribution cycle. Because this is a debt investment, you don't need to wait 10, 11, 12 years for your equity to mature or an IPO to happen or an M&A to happen. From year 1, we receive our interest and we distribute it right away to our investors. So the returns that we have in our venture debt fund, it's not unrealized gains, it's not fair market value, it's actual cash distributed. Typically, we aim for about 15 to 16% return to our investors from the debt side. That is 15 to 16% that is coming in as a cash distribution every quarter and sometimes even every month. So the fund life is also much shorter. Your typical VC funds are 10 to 12 years in their tenure. VD funds or venture debt funds, they're 4 or 5 years. So it's a much faster turnover of capital. The second aspect that I think makes venture debt very interesting is that we couple debt with warrants. Warrants are essentially like call options. They're right to buy future shares in the company at the currently negotiated price. So we don't do this for every company. In the end, our focus is on debt. But in those select high growth companies where we expect a high upside, we also negotiate for warrant instruments at the time of giving the loan. And this is an additional way that we can boost our debt returns. And typically they add about 5 to 10%. So together with the 15% yield, that's 20-25% return, which we believe is very attractive for a credit instrument that has the downside protection. At the end of this video, you'll see 2 links. One is a more comprehensive version of an explanation of debt and its proposition within the MENA region. It's a speech that I gave at our annual general meeting last year in Riyadh. So I invite all of you to take a look at that for a more comprehensive overlook. And finally, also attached is a link to our website where you can learn more about Shorooq Partners and reach out to us.